In this video, traders, we're going to talk about flexible stops. Stay tuned. Hey guys, welcome to you. Thank you for joining me. All right, so flexible stops sound like a bit of an excuse from someone who's not got that much discipline in their trading, but it's not. It's something that if you have pre-planned it, it can be very, very effective. So what do we talk about when we talk about flexible stops? So a hard stop is basically saying, hey, if the price hits this level, I am out of the trade. My trade thesis is wrong. I'm not going to give it any more room. I'm going to cut the loss. I'm going to move on to the next trade. And for risk management purposes, that makes a lot of sense. But the downside of that is that you are always going to be getting pinged out when the market just touches that level. And if you look at options probability, the chance of the market touching a level is double the chance of the market closing at that level, if that makes sense. So you're basically, and you know that yourself because you see the market oscillating around, the chance of it closing at that level at a specific time is significantly different to the price just touching a level. So you automatically statistically put yourself on the back foot, so to speak. So one way to kind of trade is to use what I call flexible stops. Now, this isn't you going, the full flexibility is I'm going to decide when to come out of a trade. Now, if you've got iron discipline, then you can operate like that. You can say to yourself, hey, you know what? If the market does something I don't like, I'm going to cut it, and I know I'm very, very good at cutting it. Most traders, that doesn't work. So there's a hybrid model I want to share with you guys now. And let me know your thoughts on this in the comment section below about this one. So this is when you have a level that you are going to consider exiting, but you also have a red line in the sand that you absolutely will cut the trade. So let's look at a trade example here. You are looking at this trend line on cable, hour chart, downtrend line. You watch the break, you watch the market pull back. You're now buying this pullback here. Okay, so you go, right, it's classical trade set up this, guys. You're saying, right, I'm buying this pullback here, and let's say you end up buying like on that day. Really, let's put these things in sort of realistic perspective. Let's take this one off, and let's put this one here and say, right, I am buying during that point in time right there, and that would be kind of a standardized trade. Markets come up, let's use an arrow, that's much easier. Arrow up, let's put him there. There you go. So we've waited for the trend line break. We've waited for it to pull back, and this is one of Peter's favorite methods. Actually, he talks about a lot of this in the Forex school. Pull back and then go, and then off to the races. So let's say you did that. Now, what are you going to do for your stop? So your stop is going to be, okay, well, if I was using the flexible method, what I might say to myself is, right, what if I don't want this trade to go under this trend line? Okay, that's my kind of level where I want to come out of the trade. However, I also want to have a real solid line in the sand. Let's put the thick one there, enter on that. That's what we want. Oh, we don't want it dotted. We want a real thick line in the sand that basically says, hey, you know what? If the market goes below, let me just change it slightly, this low, I definitely want to come out. So, if you're using a fixed level, you might say, well, if it goes below the trend line, I'm coming out. But a flexible stop basically says to yourself this. It says, okay, listen, if the price is in this area here, then I'm going to give myself the flexibility of closing it if I don't like the way that the price has come there. Now, this is where you have a little bit of intuition. This is when you kind of allow yourself to be a human being and not so much of an algo. And you go, you know what, it kind of flurried a little bit at the open because the market opened a little bit spookily. There's a little bit of news. I'm going to wait. I'm going to see. So market starts to come down lower. You then have the call whether to cut it or not. So in this zone is the flexible stop zone. Yes, it's below this trend line, which traditionally was going to be the level you came out. You didn't want to see it below there. However, it's not through your red line in the sand, your no-go zone. So the idea is if it goes to this level, you cut it no matter what. So if price comes lower, let's get the little, what's it out now? It feels like it keep moving it. I know they don't, but it feels like they do. If it went straight through, you're out. There's no ambiguity whatsoever with that. If, however, the market came down and sort of tested this level and then maybe sat around there and came back up, you've got a choice. And your choice is, do I want to close it because I don't like the look of it, because it's behaved really against the way that I wanted it to trade? Or am I going to give it a bit more room? Or am I going to close half? Or am I going to adjust the position somehow? So this is your flexible stop level. Now, obviously, you've got to be prepared for a full stop, and you've got to say, well, if I take a full hit, how does that affect my P&L? So your position size has got to be adjusted accordingly. But this gives you kind of the best of both worlds. It says, hey, you know what? I've got a level where I can choose to adjust it if I want. I'm not just going to automatically take it out, because I think, hey, actually, even if it does go to below the low, as long as it doesn't stay there too long, I'm still happy with it, because it's a multi-day trend line break. It's already had some strength, and I think that's fine. But if it carries on going lower and sits there for a day or something, then I might end up closing it. If it goes straight through and takes out that low, I don't want it anyway, because it's not only not a trend line break, but it's also taking out the low. So the thesis is properly incorrect. So that's one way of looking at it, guys. It's called the flexible stop. Let me know if you kind of like this type of stuff, if you like this idea, or maybe you implement it in your own trading. It'll be interesting to hear your flavor and your take on it. Take care, guys. See you in the next one. Bye bye.